Okay. So thanks for having me again, James and Nicole. As James said, I'm a CPA. I do a lot of speaking, mostly here with local groups, but as you can see from the people on the Zoom right now, that reaches far and wide. And along the way, I've picked up, a number of clients, along with clients that I've always had who are either buying real estate around the country, investing with others, or people investing with them who are from around the country, as well as people who move. So, at this point, I have people no longer even living in the country, in the U.S., but a lot of, folks. I heard California, I have clients in California. I heard Texas, I have clients in Texas. And actually through this group, I've actually picked up a client or two from around those parts as well, from California, from Texas. I actually have a client in California who owns property in Texas, believe it or not. So it's interesting how these things go. And I had one person once tell me that they heard my name dropped on a Caribbean cruise, which I thought was pretty interesting and cool. Of course, I wanted to know why I wasn't invited on the cruise, but long story short, I've been doing this for close, believe it or not, to 30 years. And for a good number of these have been focused really in on real estate. And like I said, I did talk last week with a local group here, and we work with a lot of real estate agents as well. So I've done many talks, and I did one earlier this month to a real estate agent group. So this is not something that I go around the country hawking my class or CDs or anything like that. This is just real world. This is what we do. So with that, let me I guess just add that we're here tonight to talk about passive cash flow and more the landlord, what I would call the rental arena. That's really what I will try to gear this to. But number one, we have a small group, so feel free to ask questions if it pertains to anything related to real estate. And then number two, a lot of times I find many people are doing all kinds of different things. They're not just doing one thing. So I would like to focus on that, but at the same time, it comes into play and in part of the discussion and the understanding of the technical parts to this, and how it directly can affect someone's taxes. It depends what you're doing. It depends if you're doing something that's passive or if you're doing something that's what I'll call active or ordinary income. And there's a difference here, because most people who are investing in real estate, they call themselves real estate investors. But when it comes to the IRS does not use that term the same way that the regular common folk will use that term. So while I might say, well, I own a rental property, I'm a real estate investor, or I'm purchasing a house to renovate it and then to sell it for a profit, I'm a real estate investor. And then there's so many other different types of things you could say you're doing, wholesaling, etc. So the IRS doesn't look at it like that. The IRS looks very simple, that rental properties are considered passive activity, and most everything else, if it's your business, that's considered what they call non-passive. You can call it non-passive activity. You can call it active activity. You can call it ordinary business activity. There's a lot of different ways to call it. There's also something called a real estate professional. So we'll talk about a lot of this in the next hour or so, try to cover what these terms mean, and then how do they affect you based on what you're doing, and then obviously based on the entities that you're using and how that affects you. So usually the way I start, and if you've heard me speak before, I hope I won't bore you, but usually the way I like to start this is to talk about the different entities that one might use to purchase and own real estate, as well as the pros and cons of those entities and how that plays a direct role in the taxes that you're paying. So, the number one thing that I find when thanks, James, there's the outline. The number one thing that I find when I meet a new client, and as James read in my bio, we have clients that own one rental property, just getting into the business. We have one of our largest clients is was one of the largest landlords in Baltimore City. They're getting up there in age and they're starting to sell some of those properties. But we have that plus everything in between. We have, that's the residential side of owning single family houses. There's also, we have numerous clients that own apartment buildings, and some, one bigger than the next. And a lot of times they start off small. So they start off owning something that they purchased, in one case for maybe $500,000 to $1 million multifamily. And then now that particular client is up to buying $60 to $80 million properties. And they manage them as well. So in that case, there's the rental side of it, there's the passive side, and then again, according to the IRS statute, there's the management side, which is an ordinary business activity. So just to give you an example there, of the spectrum, if you will. So the different entities, like I said, is an important place to start. When someone tells me, I meet someone for the first time and I say, well, what kind of entity do you have set up? And usually the answer is LLC. And when I ask them, why do you have an LLC? They don't always have the right answer or a good answer. A lot of times they'll say, well, this is what I read, or this is what I heard in some Meetup group, or this is what my friend told me to do, or that's just seemed to be the, what people do. So with that said, what is an LLC? What's the purpose of it, and what do you really gain, by owning a property in an LLC? And when is at the right time, to use that? So an LLC is a limited liability company. The main purpose, and we said before, I'm not an attorney, but I definitely get involved in these questions because they're asked to me all the time. What is the purpose of an LLC? Well, the purpose of an LLC, and I'll explain in a little bit how it does affect your taxes, but the main idea is not for taxes. It's really for legal purposes. So when someone purchases a property, for example, as an investment, and they put it in an LLC, the idea really is that if somebody in that property trips and falls and files a lawsuit, then they're not suing you personally, they're suing your company, they're suing your limited liability company. And so there's a lot of questions that I get asked in that world, many of which are legal questions. Let's say the LLC is just me. Let's say it's me and my spouse. Let's say it's me and a bunch of partners. Does that matter? Does it matter where the LLC is set up? Let's say I'm located here in Maryland. I'm purchasing a property here in Maryland. Does it matter if my LLC is established in another state, or vice versa? Maybe my LLC is in another state and I'm purchasing a property here where I live. So these are all good questions, and questions that directly refer to and explain, the fact what I'm saying, that the LLC is really a legal entity, and the idea of the entity is to protect you for legal purposes, so that you shouldn't get sued personally. And it's the same thing for all entities, the S corporation, the C corporation. Anytime you own a property not in your own name, that is the reason. And so you start an entity at the state level. So if I'm starting an LLC in California or in Texas or in Maryland, you establish that LLC in your state under your state law, and then you deal with, okay, now what does that mean for taxes? Okay, so that's really the first thing that has to be clear when it comes to entities, before we even start talking about the pros and cons of each one and what they are. So as far as the tax side of it. Well, what does it mean? So now I establish an LLC. What does that do for me for tax purposes? So for tax purposes, if I establish an LLC and it's just me, it's a single member LLC, it really doesn't do anything. It doesn't change anything from a standpoint of where that rental property activity gets reported. Okay, so what I mean by that is if I buy a rental property in my own name, in my social security number and my name, where do I report that? I report that on my 1040 on Schedule E as a rental property. And I report there the rental income and expenses. And like I said before, unless you're a real estate professional, which we'll talk about in a little while, the bottom line is it's considered a passive activity. And what that really means is that there's no social security tax on that. And so if you look at the way the tax return flows and you have your Schedule E rental, you're never going to pay social security on that income. It's simply income tax that you're going to pay, federal and state. Now, there's a huge difference between ordinary income where you're paying the extra 15% in social security tax as a self-employed person versus what we'll call passive activity and passive cash flow. Okay, so this Schedule E is where I report my rental activity if it's owned in my name. Now, let's say I set up an LLC, but it's a single member LLC. For IRS purposes, the IRS looks at that and considers that what's called a disregarded entity. A disregarded entity means that basically they look right through the entity to you personally. And so if I start a single member LLC where it's just me, and then I go ahead and I buy a property in that single member LLC and I rent it out, that rental income and expense is going to land on my personal tax return on Schedule E the same way it did before. I didn't accomplish anything for tax purposes. All I did was set up an LLC for legal purposes, for protection, but for tax purposes, there's really no difference whether I set it up personally or whether I set it up in a single member LLC. Okay, so that's so far the difference between personal and an LLC, but single member. Now let's say there's two partners or more in an LLC, and that could be spouses, that could be you and someone else that's unrelated. In that case, you now have what's called a dual member LLC, which for most purposes is going to be considered a partnership. So pretty much in most cases, that's going to default to a partnership. And in fact, when you set up that LLC, and I find this a lot, people don't understand this. When you set up that LLC and you go to get your employer ID number from the IRS on their website, and you go through that process and get your EIN, the IRS website is going to ask you, what are you? Are you a sole proprietor? Are you an LLC? Are you a corporation? Okay, I'm an LLC. How many partners do you have? If you say 2 or more, then automatically when you get that letter at the end, which gives you your ID number, it's going to tell you on there that they expect a Form 1065. A Form 1065 is a partnership tax return. So a lot of times people set something up, they have no idea what they did, and they get the letter. All they really care about is that EIN, in most cases because they think they need it or they want to go get a bank account. And in order to open the bank account, you have to have the ID number. But they don't realize, and I asked them, so, okay, you're an LLC, are you supposed to file a partnership return or is this personal? They don't really know. And so my answer to that is, okay, send me that letter from the IRS from when you set up and got your EIN. That will tell you what you did. Now, you're not necessarily, forced to do that. And, I don't usually get into that, but just keep that in your back pocket, or if you have any questions on that. If I set it up by mistake, where I said it was just me, and it's really not, or vice versa, really, I set it up as 2 people, or it's a husband and wife, or spouses, and really it's not. Really, it's just one person. Or in some cases, people don't realize that once they expect that 1065, even if there's not much activity, you still need to go ahead and file it. And sometimes I'll tell them, well, let's treat it as just you for the moment. so that we don't have to deal with it, because if there's no activity or it's not in service, you can ignore it, versus having to go ahead and file that partnership return for 1 month. Say you set this up at the end of November, and the IRS is saying, okay, well, for 2022, we expect you to file a 1065. If you file that return late, they're going to penalize you. And the penalty is a couple $100 a month per partner. Okay, so all of a sudden, you realize 6 months later, there was no extension filed. And I've seen this happen. And actually, a family member of mine, a distant family member of mine, who they live in New Jersey, who uses some accountant over there in New Jersey. We were at a family event, and it's not a very close relative, so I don't even know them that well. And he came over to me and he said, "I have a question for you. So I have this LLC, pretty dormant, not really doing much with it. And I went to this new accountant, and they told me that I had to file partnership returns. So I went back a couple of years, and we filed these returns. And I stopped him right there, and I said, 'And you got penalty notices?' And he's like, 'Whoa, how'd you know that?' He was blown away. He was telling people in the room, like, 'Oh, wow, this guy, he's really smart.' And I'm like, I might be, I might not be, but at the end of the day, I knew exactly where he was going with it, because people ask me these questions all the time, and I'm trying to guide them on getting around that, right? You don't want to open up a can of worms and file something, even if the IRS was expecting that, if it's not necessary, and it's going to end up backfiring. And in this case, cost him, at least on paper, they sent him, thousands of dollars in penalties for filing these tax returns late. And these tax returns were blank. There was zero. So it was kind of silly, to do that. So back to what we were talking about, the LLC single member, again, that rental property is going to be on your Schedule E. If it's a dual member, it's going to be on a partnership return for the most part, Form 1065. What's the difference? Well, if it's on a 1065, you're going to get a K1. That K1 is going to report the income and expense and the net gain or loss, and that's going to then go over to your personal return. Honestly, in the passive activity world, where there's no extra tax involved, the end result is generally the same thing. Mostly when you file it on your Schedule E as a rental property versus putting it on a partnership return and getting a K1 for that net income or loss number, most of the time there's not really a big difference. Without getting too technical, there are times where it does make more sense to put it on the partnership return, especially if it's large properties with big numbers. Some attorneys will tell you that you should do that anyway for legal purposes, because it's better to be a dual member entity on a partnership than a single member on your personal. So there are reasons why you might want to do it, but for the most part, it's still going to be that passive activity, loss or gain, unless you're a real estate professional, which is an election made on your personal return anyway. So there's not necessarily going to be a lot of reasons. Now, later when we talk about a couple of things, for example, the 20% pass-through deduction, potentially the pass-through entity deduction, if you're in a state that allows for that, I'll try to touch on a couple of those things. Those things do make a difference if you are in a pass-through entity in particular versus not being in a pass-through entity, meaning where you're reporting it personally on your Schedule E. So again, a little bit here about the differences in how you set yourself up and what that really means. Okay, so pros and cons of the LLC. Again, many times if you're taking out a mortgage, the lender doesn't even want to give a loan to a new LLC anyway, and so you might set one up, and then they might say, no, we're not lending to you, and then you have to buy the property personally anyway. So again, facts and circumstances will determine all of that. But pros and cons of the LLC, obviously, it's there, like I mentioned, for the legal purpose in order to protect yourself, and then it's very flexible. You can draw into your LLC. That's usually what's going to be used for the deal, especially when there's multiple partners involved, because that's where you can draw in however you want. So and so is going to get, preferred return until they're paid back X amount, and then we'll split it this way. So and so might get allocated more depreciation than the other person, the other party. All of that is very flexible when it comes to the LLC. In certain states, you're going to have fees to pay when you have an LLC. California, in particular. Here in Maryland, it's $300 a year to keep an entity open. So you do have various fees that might be involved with creating the entity. So you really should understand, the pros and cons, like I said, before you go ahead and do it. And that plays into when's the right time to do it, and another question that comes up is how many properties should I keep in any given LLC? Sometimes, again, that might be determined by a lender. Lender might say, well, once there's more than 4 or 5 properties, or some cases 10, we don't want to lend anymore to that LLC. And in some cases, they might not want to, like I said before, lend to anything to an LLC. So, I have clients that are super nervous, and they want each property to be in its own LLC. I have some that will put 1 or 2 or 3 or up to 5 in one LLC and then start a second one for the next group. From a legal standpoint, you definitely should be consulting with an attorney if you have some, for example, that you have a mortgage on some properties and some properties you own straight out. Obviously, if you have an LLC and you have 2 properties, one that's mortgaged and one that's not, and somebody files a lawsuit against that entity, they're obviously going to try to get that property that's owned free and clear. The other one the bank has the first lien on it, so they're not going to be able generally to get that. So again, these are all questions that I deal with, and these are questions that an attorney also should be involved with. I see there's a question there.
I think Evelyn's asking, is there a certain amount that you should stick to per LLC? I think you just answered that. Is that what you're asking, Evelyn, a certain amount of properties?
Yeah, I mean, if you're talking about number of properties, that's what we were just talking about. And again, sometimes it's a comfort level. Sometimes people have insurance and they're comfortable with more or less. Sometimes it's the lender that's going to say, we're not going to give it to you if it's more than a certain amount of them. Obviously, if you have different ownerships, you're not going to usually keep those together in one entity because you need to separate things. But from a legal standpoint, again, for the most part, it's all about the protection. So if you have 2 properties, both mortgage, and the lenders have the first lien, and if someone sues, they can't really grab either one, then that's a good thing. I caution people from putting an entity that they own free and clear together with a property that they have mortgaged for the purpose like I mentioned before. Okay, as far as S corporation, usually the S corporation is going to be used for the ordinary side of things, because the difference between an LLC and an S corp is whether you take a salary. So in an S corporation, you do take a W-2 as the owner of the company. In an LLC, you never pay yourself on a W-2. I see people do it. You're not supposed to do it. So other than that, an S corp is also a pass-through. It's much more rigid. There's a lot of basis issues. And if you refinance a property, you definitely don't want to be in an S corporation. So S corps are usually out for rental properties. I've seen it. I've had clients come to me and show me their tax returns. I do free tax reviews, and I've seen many times where they have rentals in S corps. It's a problem. Also, sometimes you need to do what's called a quick claim, and you have to drop that property out to yourself for one reason or another. In an LLC, it's seamless from a tax standpoint. There's no issue. In an S corporation, you're supposed to drop that at a fair market value, which if there's a profit, now you have that built-in gain, and you could be triggering a taxable event. So you definitely, almost all the time, 99%, you don't want rental properties in an S corporation. But the main thing, like I said, is that in the S corp, if you do have ordinary activity, you do sometimes want the S corp because you can save this on the Social Security tax. Now, an important thing to mention at this point is that what I find a lot in this passive activity world and I just came across this the other day, reviewing a return of a potential new client as well, and we discussed it by phone, was that a lot of people don't understand that if I'm managing my own property, those management costs or management fees, whichever way they're going, are all part of the rental activity. You can't separate the character and nature of the activity when it's all related to your passive activity, to your rental property. Okay, I had, for example, a fellow who called me. He did his own tax return, and then he got audited, and then someone gave him my number and he called me. And what he did was he had rental properties, and he also had, he was a doctor, and he had a Schedule C business for his doctor practice. And one of the properties that he had on his rental was he was using as his office, and he was renting it from himself. So I see this all the time where somebody has a rental property and they ask me, should I 1099 myself? Or they have rental expenses for their business expenses, general expenses, and they're not sure where to put that, because on the Schedule E it says, okay, property 123 Main Street, rental income and expenses, and where do I put my general business expenses? Well, those must be my business. And especially if you're preparing your own return and you're just simply answering questions from a software program, without really understanding what it means or where it's putting your answers on a tax form that's then going to the IRS. I've seen a lot of this over the years. So the main thing to remember when it comes to managing my own properties is that that's all still considered part of my passive activity business. And so if I am not a real estate professional, which we'll talk about, if I have a day job and this is just a rental property on my Schedule E on my tax return, that Schedule E on that tax return should encompass all of your activity, all of your general business expenses, all of your passive related to the rental business income and expenses, not just specifically that property and then the rest putting on a Schedule C, for example, which means it's ordinary. And so I'll give you an example. I had a client years ago who came to me, and like I said, I see this all the time, but just one that's thinking off the top of my head. And here's an example of a woman who lived in Baltimore, owned properties in Maryland and Pennsylvania, moved to Texas and Mississippi. Moved to Texas, owns property in Mississippi, Pennsylvania, and Maryland. So, again, these are things that I see all the time. And what they were doing was they were reporting the rental activities on the Schedule E and taking about $50,000 of expenses on their Schedule C, calling that their management side of their company. And what I said to them was, if you got audited and the IRS came in and looked at this, they're going to say, no, this Schedule C, which is showing a $50,000 loss, which by the way is a huge red flag if you're filing something like that. And then they're going to move that over to your Schedule E. And if you're not a real estate professional and you're not eligible to take those losses, they're going to increase your income by $50,000. Now you get to carry these passive losses forward. And if you sell a property, you get to free them up. Or if you become a real estate professional, you get to take those current losses, but you can't mix the two types of character of income. Okay, and so again, this is why people who have multiple types of real estate activity going on sometimes will have an LLC for the passive side of things and an S corporation for the active side of things. Okay, feel free to ask any questions, but that's generally some of the pros and cons and do's and don'ts of having a property in an LLC versus an S corporation, and that could cost money tax-wise if you're doing that wrong. That could definitely mean you're paying either too little or too much. Okay, when it comes to other types, we'll just breeze over those real quick. C corporation, usually that means you're paying double taxation if there's income, because you pay tax on the income, and then to get it out of there, you have to pay yourself a salary also. Otherwise, C corporations have a flat 21% tax. So if I make $100,000 in a C corp, even from a rental, and I pay $21,000 in tax, then I got to get the money out. And to take the money out, I have to salary it to myself, which is more ordinary income. So you never really want rental income in a C corporation. I've heard different speakers come up with elaborate schemes as to using a C corp as a 1% owner of this, that, and the other. And again, a lot of times when clients might come to, people come to me and we sit down and kind of unwind some of what others have, set up for them, they come to realize that a lot of that was really unnecessary. And so a lot of the benefits that you could potentially take in a C corp, usually you can take those one way or the other in any case. And so again, C corporation is usually not a good idea when it comes to real estate. Question?
Hello.
Yes, go ahead.
So when we first started our journey, my husband and I, we took advantage of buying properties under our name. And now, we do with the LLC, but I have properties now that are under my name that I would like to put in an LLC. And I'm a little bit scared because you know how they have that clause where they can call a loan. I've called the bank and I'm trying to work with them. I don't think I've reached the right person. Because I would like to let them know that I would like to put it in an LLC, but that whole scenario for me has been difficult to try to put it into the LLC. Is there any advice that you would offer?
So from what I've seen a lot of that is most of the time people just don't tell the bank because otherwise you're really at their mercy. It is written in there and they can call it. But I've seen where people they drop it in the LLC. The bank doesn't really know. As long as you're paying them, they're happy. Now, if they do find out, and I've seen that happen. I think I had one case where, believe it or not, the insurance company was told, and somehow they sent something to the lender, and the lender, realized that the person did that. Usually they don't call it, but they could. They really could. And so there's no magic that I know of. If a lender says we don't want you, moving this into an LLC, I don't know of any way, to just do that anyway.
Jeff, this is Nicole for a
Mhm.
quick question here. If somebody were to use so using what she was just talking about, Evelyn was talking about,
Mhm.
moving those into an LLC,
Mhm.
but with a land trust on top of it,
Mhm.
and you can put land trusts together for estate planning purposes.
Mhm.
So, and basically the owner or the recipient of the LLC, I mean of the land trust, is the LLC, and that is not banks can't see that. So I know of several people who have done that.
Yeah.
But I would certainly talk to an attorney or an accountant before I went down that road. But I do believe that might work.
Yeah, so I'm familiar with that as well. Thank you, Nicole, for bringing that up. Under my 1D in my outline other, what's really captured in there are things like owning property in your retirement account, in your IRA or your solo 401k, owning them in a series LLC, or in Maryland it's called a statutory trust, or in a land trust. Now, a land trust is not a real trust from the standpoint of, when you think of a legal trust. My understanding, and I'm not an attorney, is that people generally use land trusts, like Nicole said, to hide who the real owner is. It's harder for someone who wants to file a lawsuit, apparently, to find out if there's owned by a land trust who really owns it. And if you have the beneficiary or however that's drawn up by the attorney, be an LLC, for a legal purpose, does that mean the LLC owns it? And if someone files a lawsuit and they figure it all out, who are they really suing? My understanding was that you still own it unless you actually change the title. So I don't know. I can't fully answer that if that's going to be foolproof, and I don't think it is. I think it makes it more difficult for people to figure out who the real owner is.
basically what I was saying, and I probably wasn't very clear, is that the actual legal owner becomes an LLC rather than a person, but you put the land trust on top of it
Hmm.
for privacy things, and you have a legal right to put something into trusts for estate planning purposes. So is that what you're saying, that because you are changing the ownership
Yeah,
to
you
an
are.
actual LLC?
Yeah, yeah, you're changing it, and then you're trying to hide it. That's what you're doing. And that might work. Again, I think it really depends on the lenders. But most people, uh, for the most part, they just move it and hope that they don't find out and they don't call it. But this could be a little bit of more of a foolproof way from a standpoint of them finding out. Okay, so that's all of that as far as owning in a retirement account. I have a lot of clients that set up self-directed IRAs or solo 401ks and own property, lend money, all kinds of real estate types of activity, flip houses in that, with that retirement money. And so if you can generate ordinary income, which is not what we're talking about this evening, but if you can and you put money against it into a retirement account, you can only put money into a retirement account if you have earned income. Okay, rental property, rental income, even if you're a real estate professional, is never earned income because you never pay Social Security tax on it. So technically, you can't then put away money into a retirement account against that income. Okay, but if you have ordinary income and you do, then you can then in turn start, put it into a retirement account and then use that to buy passive, activity incomes, properties, I should say, which generate passive income. So that's kind of under my D there, if you will. Counting and bookkeeping, I usually save a little bit for the end. So let's talk now about being a real estate professional. So there's tests, there's rules. I keep mentioning passive, active. I keep mentioning, can you take losses? Can you not? Generally speaking, if you have an investment, if you're a real estate person and you come to me and say, hey, I need an investor. Can you put some money into my deal? And I give you money, and now I own a little piece of the deal. I'm what's called a passive investor. And if I'm not actively involved, I don't have anything to do with it. I gave you money, and that's it. Then when I get that K1, if it shows a loss, then I can't really do anything with that loss. I can only use it to offset other passive income. If I have no other passive income, I can't even use that passive activity loss. Now, there are many creative ways to create other passive income, depending on a person's, situation. But I'll get back to that in a second. So that's what I'll call the bottom, rung, the bottom level of being classified in real estate. Now, the middle level is I'm actively involved. I have some say. There are some tests as far as how many hours I spend a year on it, on the activity, etc. But in that case, if my income is low enough, I can then take a certain amount up to a certain amount of those losses. And the way that works is simply between $100,000 and $150,000 of adjusted gross income, I can take up to $25,000 of losses. So if my investment in your deal generated a K1 with a loss of $10,000, if my income is below 150 and it's two for one basically, as far as the phase out between 1 and 150, that 50,000 versus the $25,000 allowance, then I may be able to take that $10,000 loss. But if I make more than 150 and I'm not a real estate professional, I cannot take that loss. Again, unless I have other passive income. Now, if I'm on the top level, as a real estate professional, what that means is that I have 750 hours a year in real estate and more than 50% of my time in real estate. And the key word is and, it's not or, it's and. So most people who have a day job and they're not in real estate, even if you have 20 rental properties, the IRS will not want to consider you as a real estate professional. I have clients that come to me and say, no, I'm a real estate professional, even though I have a day job, and we discuss it. But for the most part, if you look at the tax court cases, the tax court basically says that if you have a day job, then you are not considered a real estate professional. And so now, if you can meet that test, or if one spouse doesn't work and they're the spouse that's running the real estate business, they can be classified as real estate professional, which means that they can offset these losses now if they have real estate rental losses against other ordinary income. And so you might have someone who's a professional, either a medical professional or an attorney or whatever the case is, who makes hundreds of thousands of dollars from their business, and they're taking that money and they're investing it, in real estate. And so now the question becomes, if they can't be a real estate professional, they can't even get those losses. Now, how can you be creative and create other activity, passive income, in order to then use those losses to offset each other, without getting into too much technical terms and examples here. There are ways to do it, depending. If someone just has one rental property and it's a loss, or one K1 and it's a loss, you're pretty much stuck. But if you have multiple streams of income and multiple streams of income, whether it's in real estate or not, there could be ways to set yourself up correctly in order to make sure that you have this passive income to help offset the passive losses. Okay, so again, just keep that in mind. It happens to me all the time. I get a new client, they have some rental properties, and then they want to know, they switch to me as their CPA, but it didn't really help them all that much. And the reason is because they're not getting the losses from those rental properties anyway, because they're not real estate professionals. And sometimes there's nothing you can do about it. There's no other activity. They're both getting W-2s, have day jobs. They don't qualify. And it is what it is. So those are the rules of real estate professional, and how you get classified, as such. And again, I usually look at it like there's 3 tiers there, as I explained. So hopefully that gives you a couple of ideas as well, as far as what you're able to do with that. We mentioned a little bit. Question, can you repeat the criteria for real estate professional? 750 hours and more than 50% of your time in real estate. Okay. We talked about the retirement. I don't really dwell on that in this setting, because like I said, for the passive activity, it's not really going to be so it's not going to be so applicable. And then when it comes to some of the new tax law, we'll save some of that for the end, but the Secure Act really has to do with retirement planning. That was the Act that 2.0 that they just passed recently. So there's some new rules as it pertains to retirement and what employers have to do, etc. The government trying to encourage people to to save up for retirement. Let's talk for a little bit about the deductions and certain things that I get asked about a lot, as well as some of the miscellaneous issues, and then we can circle back, talk a little bit about some new tax rules and some things that you may not have heard about, as well as finish off with some accounting and bookkeeping issues. So when it comes to certain real estate expenses or general expenses, now remember, the key is not to change the nature of the category of the expense. If you're in a passive activity, it's passive. If you're in an ordinary activity, it's ordinary. If you're doing both, then you have opportunity, to move things around potentially. But the types of expenses that I'll call personal versus business or mixed use, those are the ones that I get often asked about the most, because someone says to me, well, how do I determine how much of my car is business? How do I determine how much of my home is business? How do I determine if I pay my cell phone bill, how much of that is business? And so, the general rule of thumb is, unless you're, keeping real logs, which you're supposed to, you can make a good estimate of, I'm using my cell phone 50% for business use, and you can deduct that. We'll talk a little bit later about the accounting and bookkeeping side of that. How do you figure that out, and how do you book that if you're keeping real books for your company? But when it comes to your cell phone and things like that, again, you can take a percentage and whatever makes sense that you can back up, obviously, when it comes to taking that as a deduction. When it comes to your car, the rule there is that you can take the mileage rate, which is very high this year. It's well over 60 cents a mile already, 62, 63 cents a mile, versus taking actual. So actual would include all your actual expenses, your gas, your insurance, your repairs, and if you buy a car, it's depreciation, taking depreciation. If you lease the car, you can take the lease payments. Again, we're talking now if it's 100% business use. If it's something lower, you take that percentage, or you take the mileage rate. You can't do both. You can only on one car take either the mileage or the actual, and you can switch from mileage to actual. You can't switch back from actual to mileage. In 1 year, though, you could say, well, I drive my car, I'm taking the actual, and then I drive my spouse's car, or I have a second car, and I'm going to take the mileage on that one. So you can mix that way where it's two different vehicles, but not when it's the same one. I put on here real estate education for really the new people in the business, and it's really not just real estate, it's really any business. The IRS has what's called startup cost rules. And so when I start a new business, how do I determine whether I'm allowed to deduct those startup costs or not? In some cases, you can't deduct startup costs at all. And in some cases, you have to amortize them over a number of years. And then in some cases, you can actually take them all right away, right off the bat. And so, again, without getting now into all those rules, just keep that in mind if you're starting that out. Now, if you buy a rental property, even if it's your 31st rental property, when you buy that property, you have to wait until it's available to be placed in service, available for rent, until you can start deducting any costs associated with it. And so a lot of times people buy a property and then they spend some amount of months fixing it up, renovating it before they can get a tenant. So at what point is it considered, at what point is it considered that they are, that property is in service? That's really something to keep in mind also, especially when it comes to now filing your 2022 tax return. If you're a real estate professional, for example, and you bought some new properties and you want to take advantage of the money that you spent on it, making that determination is important to help you figure out which properties you can include, which expenses you can include, as of when can you include them. These are all important things. We didn't really talk yet about depreciation, but let's talk a little bit about depreciation. And then under new tax law there in the outline, I wrote bonus depreciation. And what that's all about is that when you buy a property, you can't just write off the whole thing. If I spend $50,000 on a house and $50,000 in renovations, I can't just take $100,000 in as a deduction. Now, the IRS tells you how long that property, what the life of that property is, and how long you have to depreciate it over, and you get to take a piece of it every single year. If you have business assets like your car or your computer, or certain types of assets related to a rental, when it comes to things like the kitchen equipment, the laundry equipment, things like that, or carpeting, right? When can you take what's called bonus depreciation? Bonus depreciation up until recently, or I should say recently up until 2023 until now, it has been at 100%. And so if I buy a new laptop for my business at $1,000, I could write off the whole $1,000, and that's even if I have a loss. There's another type called Section 179, which can't create a loss. Now, bonus could, but bonus in what I'm calling new law is really old law, it was sunsetting after 2022, and it just dropped in 2023 now to 80%. Okay, so if you buy that new laptop today, instead of being able to write off 100%, you can only write off 80%. The question becomes, if I bought a property sometime in 22 and did work to it, do I have an opportunity to take depreciation? Do I have opportunity to take bonus depreciation? And if I can do that in 22, I get 100% of it, as opposed to if I have to wait until 2023, I may only get 80% of it. There's talk of them changing it, but right now it's anybody's guess, and it doesn't look like too much is going to happen or change at this point. So this is, one of those things that is at the top of the list, but there are a number of tax items that have changed because they sunsetted after 2022, and the percentage, like this as an example, changed for 2023 that people don't realize. Anybody with children knows last year you were getting this big child credit and dependent care credit, and that's gone. So, I forget how, I was reading some articles how they're referring to it as refund shock. This year people will not necessarily get the same amount as what they got last year for these reasons. But when it comes to real estate, this depreciation change and bonus, it's a big deal, especially if you do what's called a cost segregation study. I know some of you, I believe, that are on here tonight know and appreciate what I'm talking about when it comes to the cost, and feel free to jump in. When it comes to a cost segregation study, what that means is accelerating depreciation. And again, if you do a study now on a property, if it's large enough and it's worthwhile, then you can accelerate depreciation. And my understanding right now is that you'll get, if you do it for 2022, and you can still do it now for last year, you could accelerate that the 100% on those qualified assets versus what, this year looks like they might only be at 80%. Okay, and so these are things that, analyzing your situation right now in January, it still can affect your 2022 and also affect your 2023. I didn't write it in the outline as far as some, the cost segregation, but there's also net operating loss rules, which were changed a couple of years ago. Used to be if you had NOLs, net operating losses, you could take those and carry them forward and use them 100%. At this point, you can't do that anymore. They changed it that you can only use and to wipe out up to 80%. And so that's something that, again, creates a good opportunity for tax planning. There was a question there?
Yeah. How do you feel about taking meals as an expense? For example, I went to Baltimore this past year and had different meetings over a meal. Is that okay to conduct? By the way, it's 8:00. Just wanted to give you a heads up.
Yeah.
But, the meal thing.
Yeah, I mean, last year you could take any restaurants at 100% if it was business. This year it's back to 50%, and you can't take entertainment anymore, but you could still take meals related to business at 50%. That's fine. Okay, so again, just kind of moving around the outline here, self-employed health insurance is also based on paying self-employment tax. So rental properties don't do that. If you have contractors for your properties that you've paid more than $600 to for a service and they're not a corporation, you have to give them a 1099. Those are due January 31st. So you have about 6 more days to officially to get those done and issued. If you don't have their information, that's a problem. You're supposed to get it. We talked a little bit about paying yourself. Again, when it's just a pass-through or an LLC, rental, etc., you don't pay yourself salary, so you just cut a check and it's just an owner distribution and owner draw. I'm asked a lot about using your home for business. It's not necessarily all it's cracked up to be, simply because if you're itemizing on your personal return, you're already taking your mortgage interest and your taxes anyway. And so now you're taking, a room that you're using for business, let's call it 10% of your house times your utilities and whatever else you can drum up, unless there's some significant repairs to that room directly. The way I tell it to people is, say your utilities are $500 a month, so you're spending about $6,000 on that, and you have a security alarm and landscaping, some cleaning help, whatever the case is, you have about 10 grand of expenses at 10%, you're taking $1,000 deduction at, you know, whatever tax rate you're in, whatever tax bracket. And so if that's saving you a couple $100, it's not something to, you know, be super aggressive with. And in fact, a few years ago, the IRS put in a safe harbor for business use of home of $1,500. So a lot of times people will just take the safe harbor and take the $1,500 deduction and be done with it. As far as other new tax laws, if you do have employees in your business and you had a reduction in 2020 and 2021 over 2019 in gross sales, you could be eligible still for an employee retention credit. Anybody who's alive and breathing probably heard advertised somewhere over the last several months the employee retention credit. I get these emails from clients all the time. Got one today. It's all advertisement because these companies are charging a percentage of the credit right now. So if they get you, you know, a $10,000 credit, some of the attorneys want 33%. So you know, one of my clients just recently received about $800,000 in employee retention credits, and I have some clients that I know of who've gotten more as well. So it is a real thing. It's not a scam, but I wouldn't necessarily just respond to an advertisement. But you want to really know whether you you know, qualify for it, and make sure you know how much you're getting, and that they know what they're doing and they're doing it right. I mean, you know, a lot of these, they just want you to go to a website and type in your information, and then they'll tell you how much you can get. I'm not sure that's the best way to do this, but there is that. As far as the 20% pass-through deduction, I mentioned that earlier. It's something that was being talked about going away, but it has not. And so if you do have a Schedule C even, or in most cases, if it's your active business, even a rental schedule could qualify for it. It's called QBI, Qualified Business Income. And if you have an LLC or an S corporation, you can take 20% in the real estate world you can take 20% of your income as an additional deduction. Then there's the pass-through entity deduction, which is really what they call the SALT, state and local tax workaround. So I know there are certain states, you know, New Jersey, Maryland, Ohio, there could be others that have this, where if you make a lot of money, you pay a lot of state taxes. On the Schedule A, it's been capped at $10,000. This is a way to pay your state taxes through your entity and take a federal tax deduction. You can do that in several states. So another way to pay your personal taxes that you're paying anyway, and where you weren't getting a deduction for it before, you can get that deduction now. This is pretty significant, and we've been doing that here in Maryland for a lot of people. Let's see, a couple other things that I just made a couple of notes on here. We talked about cost segregation, other ways to potentially save money, especially in the passive activity world, is 1031s. I'm sure you know, anyone here in this session who's sold a property is familiar, hopefully, with what a 1031 or a like-kind exchange is. They recently changed it that it's only real estate, not other property. So it still applies. They were trying to do away with it altogether so that people would have to pay the tax, but it is still there, and I see a lot of it. And that's really how real estate people grow. They sell property A, and then they buy property B. Maybe they bring in some investors. They sell property B, then they buy property C. They do these cost segregation studies on the property, so they generate tons of deductions and losses. And you know, honestly, that's why you know, I have clients who make a lot of money, cash flow, but when it comes to their tax return, they don't show very much. And that's why, at least when you're like me and you understand how the tax returns work and what the laws are and the rules are, when it came to, for example, someone like Donald Trump not wanting to show his tax returns to people, and believe me, I've gotten emails from clients, how do I do what Trump did? I get that all the time. But it's not surprising because people don't understand, they don't understand it. And so how could it be that you're making money but not paying taxes. That's not fair. Well, if you play within the rules correctly, that's something that you can accomplish. And so again, these are just, things that are out there. You can sell a property on an installment sale and make an installment note. If you're going to get paid back within more than a year, you can defer the tax there and some of the gains. So there's a lot of different ways in the tax world and the code that you can defer gains as well. And so the idea is to create capital gains. Keep in mind, depreciation is recaptured, and so that's part of the problem selling a property. You're paying additional taxes, and recapture of depreciation is at 25%. A lot of times when I finish a tax return, somebody who sold a property says to me, how do I owe so much? And the answer is because you had a profit from that property and the recapture of the depreciation. Because they say to me, well, how did I didn't make 100,000 on that property? I only made 50. Well, you made 50, but you took 50 of depreciation. And so now your basis got reduced. And so your gain increased. Okay, so hopefully that makes sense to everybody, and you understand that. So that's, again, a couple of other ideas there. One other thing that's pretty hot, and then I'll finish up and take the rest of the questions, is Airbnbs. Seeing a lot of Airbnbs and a lot of question as to how to treat them. Is it a rental or is it a short-term rental? There's a big difference. If something's a long-term rental, it's a passive activity, it's subject to capital gains and no self-employment tax. If it's a short-term rental and that's your business, that very well could be treated as a self-employed type of business, not a rental, not a Schedule E, but rather a Schedule C ordinary business, again, subject to additional tax. So somebody paying the highest bracket might pay 35% for real estate rental income, but if it's an Airbnb and if it's treated and classified as a short-term subject to SE tax, you could be paying 50% because there's an extra 15% for that self-employment tax. And so that's a big one too. And what I find is that if you speak to different people, you'll get different answers. And so it's, again, important if you are doing that to understand it and understand how you're being taxed and how that's being, treated, as well as, like we said in the beginning, what entity you're using for these things. Okay, because again, you've more of a chance of getting sued as well. And again, I don't know the Airbnb, rules as far as lawsuits and things like that. I'm not even going there, but if you have a new tenant in there every couple of days, that's different than having a long-term, person signed up for the next 12 months. So, some things there to be aware of when it comes to the Airbnb. I see a lot of that as well as a kind of hot thing right now. So let me close with a little bit about accounting and bookkeeping. I'm asked a lot about that. If you have one rental property or two rental properties and they're small, you could potentially get away with Schedule E. There's no balance sheet. There's no assets or activity or liabilities that need to be reported. And so, clients of mine will give me, here's my rental income, here's my rental expenses, here are the renovations that I put in for depreciation purposes, and that's it. But if you are filing a 1065 in a partnership, be aware that you really need to have some better bookkeeping. And I would say if you have large properties or if you have many properties, you should really be doing it the right way. Most of our clients are using QuickBooks. You can use what's called a class system in QuickBooks, which means that, across the top are the properties and then everything's kind of in the, drops down into the column. And if you're using it right and you're reconciling your bank account and everything is in there, you'll have a nice profit and loss and balance sheet. And a lot of times when you go for a loan, that lender wants to see a financial statement. And I get requests all the time from people who are not keeping books. Hey, I need a financial statement. What do I do? And then we have to scramble to try to put something together for them. And so it's a good idea to try to, give that some thought. And again, I would say if your plan is to grow, you probably should try to get that going the right way, earlier rather than later. The problem, honestly, is that most people are not bookkeepers and not accountants, and they don't know how to do it, and they don't have the money to pay for it to get the help that they really need until they're big enough. And it's so messy that sometimes it's either super expensive to fix or it can't even be fixed, and they just start from scratch and move forward. So again, just kind of some real world, things out there that I've seen that I wanted to, just bring to your attention. Okay, so it's about 8:15. So let's just take some questions and then we can wrap it up. And I appreciate everybody joining and listening. My information is on the bottom of that outline. If you want to reach out, you can send me an email.
I'll also put it in the chat for you. I'll put your email and your phone number.
So I'm Jeff at katzcohen.com, and my phone to the office is there as well. Okay, so what questions do we have?
Evelyn, I think this is pretty funny because some of the stuff that Jeff was talking about is really complicated. And you asked, what's a good book to read on tax? I'm thinking, oh my gosh, why would you put yourself through that? But I don't know if there is there like a tax book for beginners or something like that? Or
yeah, I've been asked that before. You're not the first one, but I really don't have an answer for that. I don't know.
And it changes all the time too, right?
It does. Yeah, that's what I was going to say. People try to Google things, but that's never a good idea.
Makes total sense. And I think, let's see, Jerry says, thanks. Always learn things when I hear you speak. Book, taking meals, criteria for sales. You said that. Certain amount if you stick approved for LLC. I think one of the questions that somebody asked was, when you set up a 2-person LLC, does it have to be a 50-50 split, or can it be like 99-1 or something like that, so you can get that dual member LLC?
Yeah, we do that all the time. It can be 99-1.
Okay, awesome. And then Darren raised his hand. Darren, go ahead.
Oh, hey, how you doing? Can you hear me?
Yes, absolutely.
Okay, I just want to get your opinion on what's a good lender that I can probably go to get a loan. I have a commercial loan and my loan is coming due, and I don't like the company that I'm working with, so I want to refinance that loan. Do you know of any good lenders that I can use?
Who are you asking?
I'm asking the speaker.
I would defer to James. James, I have a lot of clients and they use a lot of different people, but I don't usually get involved in which lenders they're using. I do have connections to those, people, but I would say, your best bet is probably people like James who, are familiar with all the people in the group and what they're doing.
Okay, well, I'll put this out for the group. If there's anyone can help me on a really good lender that, because I want to consider refinancing.
Hey, Darren, if you want to send me an email, if you're local, there's a couple of local lenders that are pretty good. It's James at passivecashflowforlife.com.
Okay. At passive, okay.
Cashflow for FOR life.com.
Okay.
And give me some details. Is it, a large apartment building? Is it one house? Where is it? That kind of thing.
Okay. Well, thank you, James.
Mm-hmm. Sure. Glad to do it. Anybody else? Nicole, any parting words? The chat caught her off guard.
Yeah, I don't. I guess my sense is that you benefit really by finding a good attorney and a good accountant. Even if you don't have a lot of money to start out with, getting yourself started in the correct way, and basically going forward that way, you learn a lot as you talk to good team members. So as things come up, part of what Jeff does is he teaches as he kind of talks to you about different things. The other thing, I don't know if you still do it, Jeff, but Jeff used to do a free basic analysis of your tax returns to see if there's areas where he could save you some money and things like that. And that might be something to think about taking him up on. But you just can't beat having good professionals on your team, as far as I'm concerned.
I agree 100%. So, and Jeff, I was surprised the first time I met you. You actually sat down with me in that little conference room up front. I'm like, oh my God, how much is this going to cost me? And I was like, nope, first time it's free, So, and it really, you gave me a lot of information. It wasn't like just a little bit and then kind of a takeaway. So I really appreciate that. If you guys have more interest in multifamily, I just put up a free webinar that Nicole recorded. It's about 2 hours long. It's that link right there, bit.ly at Passive Wealth Seminar or Webinar. You can just cut and paste it or click on it. It'll take you to the page and you can bookmark it. Jeff, any final words?
No, just, we still do the free tax review. Right now it's getting a little bit late for the, 2022 season. I've had several people, where I've told them I'm not sure, that I can really take it on right now, but, I'm happy to review returns. I'm happy to talk to anybody and see what makes sense and what's best fit for them and for us as well. But again, like Nicole said, I would just echo that, it's important and, it's never a bad time to, think about all of the stuff I talked about. And I tried to, give you a broad kind of spectrum on it, but, there are definitely a lot of opportunities in this world and in this, real estate world to when it comes to taxes, to, like I said in the very beginning, paying too much or paying too little and planning for it. It's very important to understand it and plan for it because you really could, benefit a lot from it. Thanks for having me.
All right. Thanks, everybody. Have a great night. We'll talk to you soon.
Good night.
Bye-bye.